Hello everybody, we've just learned the balance sheet and now it's time for us to learn market to book ratio. Market to book ratio is one of the important balance sheet analyses. It's a ratio of the market value of equity to book value of equity. It's also called the price to book ratio. Market value of equity equals share price times shares outstanding, which is also called market capitalization. Book value of equity is shareholders' equity on the balance sheet. It equals total assets minus total liabilities, which we've learned in the previous video, balance sheet. Let's take a look at Company A's balance sheet. The total shareholders' equity equals $12.06 billion. On December 31st, 2018, Company A has 3 billion shares outstanding. The market price per share is $25. Now we calculate Company A's market to book ratio. It equals share price times shares outstanding divided by shareholders' equity. And we use $25 per share times 3 billion shares outstanding divided by 12.06 billion of shareholders' equity. In the end, we get 6.21. That means Company A's market to book ratio equals 6.21. For most successful firms, market to book value exceeds 1, which indicates that the value of firm's assets exceeds their historical cost or liquidation value. If market to book ratio is smaller than 1, this is a reflection of investors' assessment that the company's assets were worth far less than their book value. Look at the table. We see that the price-equity ratios of UBS Group, Volkswagen, Citigroup, and Deutsche Bank are all smaller than 1, while S&P 500, IBM, PepsiCo, and Apple Incorporation are much higher. The diagram gives us a better look at price-equity ratio on February 12, 2019. Firms with low market-to-book ratios are classified as value stocks or value shares, and those with high market-to-book ratios as growth stocks or growth shares. Thank you for watching. Enjoy your learning.